Let's continue that stimulus discussion with Dr. Stephen Nash from FIG Securities, coming to you live from Sydney. Good morning to you, Stephen. Nice to talk as always. Stimulus, well, it's not quite what we're talking about when it comes to the Reserve Bank's dilemma at the moment, but still an interesting call from you on Tuesday's statement. If we just reflect on this now, bring it home for viewers domestically where it really matters. Yeah. What are their core concerns that you've seen spelt out?
Well, I think there's two stories. The story firstly was concern about the trade situation and the resources sector of the economy pushing up demand for labour, and then that leading to inflation. But recently, the RBA has highlighted the concern with the consumer becoming more conservative. A lot of commentators have said that, well, this is just a temporary thing and will go away. I think the RBA are looking at it as a more structural issue, and that this consumer conservatism is here to stay, which basically will moderate inflation going forward.
It was interesting that you've then used the language of concern. Are you using that quite loosely in a sense? Because in a way that helps their overall position, does it not? It puts them in a sweet spot.
Yeah, it does. Look, they've taken policy to a moderately restrictive level, which basically means they're already in front of the curve, as they say. They've reacted quickly and earlier than a lot of other central banks. Now they're in a position where they can sit back and monitor the data as it comes out, with a view to seeing if they need to take that extra step and make policy much more restrictive than it is at the moment. Now, we have the problem of floods and other issues at the moment. We've just had the GDP numbers, which were reasonably good growth, although it wasn't, I suppose overall growth wasn't that strong, and basically we're facing a information blackout for the next 2 quarters because the data will be really affected by the floods. Some have already said that the GDP number we just got was already affected and dragged, and there was a drag on growth of about 0.4%, but I think we're facing a period where the RBA will find it very difficult to do much.
No question on that. If already the consensus being that Q1 is going to be ugly, but that's for reasons, as you've just explained, Stephen, now well flagged by the markets. I guess it's then the rebound, the swift uptake on construction, capex. We know businesses are ramping up their own plans in that space. The wild card, and this was put out there by Arab Bank today, saying, look, will the strong labour market prompt confidence from householders in the quarters ahead? Will we see that optimism flow through in that space?
Look, I think consumer optimism will follow growth to some extent. However, I do accept the idea that consumer conservatism has gone up, or saving has gone up in a structural sense, and that we won't see a radical change in that. So, yes, the saving rate may drop a little bit, but not radically, and so that means inflation should be moderated going forward. It really depends on the strength of this uptake in the resources sector.
How much is a high oil price for Australian consumers going to offset that uptake that you've just flagged there? In other words, in the same way we've been arguing about in the US.
It's really a direct a call on people's spending power, so it's very similar to an interest rate hike. And that's affecting not just Australia but global conditions. Now, a high oil price itself may impact perceptions of global growth to the extent that other commodities may start to come off, in the sense that, if oil goes higher, and it appears that the trouble in the Middle East is not going away soon, and it probably will, that this whole complex of commodities may come away because growth expectations just diminish that much.
Are you talking demand destruction?
Sorry? Yeah.
Effectively,
it's effectively like tightening policy. This is just not what the US needs right now. They've got a very emerging recovery. They don't need an effective monetary policy hike via the oil price.
Stephen, it was really interesting just speaking to some US guests, a US guest, Phil Flynn, moments ago, ruling out this idea, as is done in Asia, in many Asian economies, where authorities there will cap prices for consumers on crude. In other words, the price at the pump will not exceed a certain threshold. Why do we rule that one out here?
Look, I think government intervention on the oil price is a possibility, but look, I think it's, it's probably unlikely.
Well, they're intervening everywhere else, Stephen.
Yeah, I think Australia adopts a lot of the more advanced economy practices, and that is to not intervene in these situations. However, if we get oil prices at $200, there could be some measures introduced, I would have thought.
All right, the lone voice around the Reserve Bank table, Warwick McKibben, soon to exit stage left, using the S word, we're referring to stagflation.
Yeah.
Again, is this just a sort of a final salvo before he exits stage left?
Look, I think the idea that commodity prices will feed into inflation is a real threat at the moment. However, I think commodity prices are driven by perceptions of growth. If those perceptions moderate, then commodities are not going to continue to go up. They're going to come off, and they come off, as you know, very quickly. I think the Treasurer has been highlighting the importance of commodities, but the problem is, and I think the RBA government has said it a few times, that they're very notoriously volatile, and we could see commodity prices halve very quickly.
Well, we've seen not so much halving, but a pairing of growth expectations in China's economy this week. But many would say that's healthy. That actually does some of the heavy lifting that the state would otherwise use the old sledgehammer to ruthlessly do. Yeah,
well, the Chinese have recently reduced their target growth forecast, although actual growth has always been exceeding that. And it's good to see some moderation there, but moderation in China is also good news for the RBA because it takes the pressure off resources. I think this is another emerging story, that this moderation of growth in China, which again will take the pressure off the RBA.
And yet, as you say, if history's a guide, they'll overshoot at any event. Is this just a bit of jawboning?
Yeah, well, it is a bit of jawboning, and I think they need possibly more tightenings in China, and they're on the track to do that. I think that's going to be positive in the interest rate outlook here. Take the possibility of a tightening away. Here.
What about the outlook for rates in the US? Meanwhile, you've got an interesting call from where the Republicans now sit with a whole lot more clout after those November midterms, Stephen. If we're talking sizable cuts, is this going to bring us more into a realm of a similar theme to the one playing out in Europe? So the US was putting stimulus in while Europe said it was all about prudence. Are they going to go that same way?
Well, look, I think the US, I think this budget showdown in the US is really positive for bonds because it cuts supply and also cuts growth. That's fantastic for bonds. I think bonds have been holding in quite well of late as a result of that. They want to see the outcome there. Republicans are really going for radical cuts in spending. The Democrats are trying to moderate that, but at the end of the day, we're going to get lower spending in the US, and that means less supply, which I think is going to be positive for the US Treasury market.
You think politically that there's the will to do that, to bring it about?
Definitely on the Republican side, and the Republicans have got the numbers right now. It's a question of how much they push it. If they push it too far, they could damage their electoral prospects, I think, and that's what the Democrats are hoping they're going to do, I'd say.
Maybe they'll feel emboldened if those numbers overnight in the private jobs survey play out on Friday to suggest that the private sector is doing its bit now of heavy lifting. It's not all down to public debt, public borrowing.
Yeah, we've had this ADP report a few times, and it's been suggesting a good number, and it really hasn't come about. I think we're about to get possibly a very good employment number, but then again, the problem will be what effect will oil have on growth? Even if we've got the economy starting to recover, what is the forward perception of growth? And that's going to be damaged, I think, by this oil price.
Stephen Nash, it's going to be compelling in the weeks, months ahead. Thanks for now. Have a good day.
Okay, thanks very much.
Cheers. Stephen Nash there from